In this lesson, we examine two of the most critical threats in financial crime compliance: terrorist financing and money laundering. While these two crimes are often discussed together, they are fundamentally different in how they work. Understanding that difference is essential for any compliance professional. Here is the core distinction you must internalize. Money laundering hides the source of funds. It moves dirty money backward through the financial system to make it appear clean. Terrorist financing, or TF, works in the opposite direction. It takes funds and directs them forward toward a future criminal act. This reversal of the money trail is critical. TF can involve entirely legitimate money, and even very small amounts can be enough to finance a devastating attack. Terrorist financing draws from two broad categories of sources. The first is legitimate sources: salaries, personal savings, business income, charitable donations, and crowdfunding that are later diverted to terrorist purposes. The second is criminal sources: fraud, smuggling, extortion, kidnapping, trafficking, and theft used to raise operational funds. Because legitimate money can be involved, standard red flags for criminal proceeds may simply not apply here. Once funds are raised, they must be moved and stored. On the movement side, terrorists use banks and wire transfers. Money services businesses such as currency exchanges and remittance providers, hawala and other informal value transfer networks, charities and online platforms, and cash couriers physically carrying money across borders. For storage, funds are held in bank and business accounts as physical cash or prepaid cards, within charity accounts, and through trusted associates or family members. Each of these channels presents a unique detection challenge. This brings us to why TF is so difficult to detect. Transactions do not need to be large or structurally suspicious. Small routine payments can fund serious attacks. Standard transaction monitoring thresholds may miss them entirely. Context is everything. A transaction becomes suspicious not because of its size alone, but because of who is involved, where the funds are going, and what behavior surrounds it. You must look beyond the amount and examine the full picture. Let us recap the 4 key takeaways from this lesson. First, terrorist financing is always purpose-driven. It funds a future act, not a past crime. Second, the money can originate from entirely legitimate sources and still constitute terrorist financing. Third, small amounts matter. Even minor transactions carry serious risk when context is considered. Fourth, stay vigilant. Behavior, relationships, geography, and transaction purpose are your most important detection tools. For additional study resources, visit CAMSPREP.com.